One checkbox. That's all it takes to trigger an IRS investigation that could delay your citizenship for months or put your green card at risk. In 2026, the rules are changing in ways that specifically target seniors and immigrants with even modest overseas ties. And the terrifying part? The changes are already finalized. No one is sending you a warning letter. No one is explaining what you need to do differently. When you file your 2026 taxes in early 2027, the system will simply expect you to know. And if you don't, automated flags, audit exposure, immigration delays. I've watched families lose thousands in legal fees over a single unreported foreign account worth less than $15,000. This isn't about hiding money or breaking laws. This is about everyday people getting blindsided because the landscape shifted and nobody told them. Today, I'm breaking down exactly what's changing, why you might be at risk, and the 5 critical steps you must take before this becomes your nightmare. Introduction. Hi, I'm Ricardo, and welcome to US Immigration Info. For years, I've been tracking the intersection of tax policy and immigration law, specifically the regulatory changes that quietly devastate seniors, green card holders, naturalized citizens, and long-term visa holders. I've seen too many hardworking families destroyed financially and emotionally, not because they were dishonest, but because they simply didn't know a reporting requirement existed. My mission with US Immigration Info isn't to scare you. It's to ensure you're never caught off guard. Think of this channel as your early warning system for policy changes that could affect your finances, immigration status, or long-term security in the United States. When something shifts that could impact your life, I break it down in plain English so you can take action before it becomes a crisis. And what's coming in 2026 is exactly the kind of change you need to understand now. Because once the new enforcement system is operational, fixing mistakes becomes exponentially harder and more expensive. Section 1. What's actually changing? Let me be crystal clear about what's happening. The IRS has finalized a new reporting framework effective with the 2026 tax year. This means when you file your taxes in early 2027, you'll be operating under completely different expectations. This isn't speculation or rumor. It's embedded directly into updated filing instructions and compliance procedures tied to Form 1040 and related foreign asset reporting requirements. Here's the fundamental shift. Questions that previously existed quietly on specialized international forms are now being pulled front and center onto the main tax return that everyone files. What used to apply primarily to high net worth individuals or internationally complex taxpayers is becoming unavoidable for everyday seniors and immigrants with even modest overseas connections. Under the new structure, expanded foreign asset disclosure questions are being integrated directly into the standard filing process. You won't be able to simply overlook them because your accountant didn't mention it or because you assumed it didn't apply to you. The system is forcing clarity and transparency. If you have any of the following, you're affected: foreign bank accounts, overseas pensions or retirement accounts, foreign social security type benefits, shared property abroad, any financial footprint outside U.S. borders. The form will ask you directly, and your answer won't exist in isolation. It will be digitally cross-referenced against other filings connected to your name, your social security number, and your immigration records. Section 2. The Threshold Shock. Now, many of you might be thinking, I've always answered the foreign account question on my tax return. What's different? The difference is scope and enforcement. Previously, deeper disclosure requirements were triggered only after certain high thresholds were met, and they often required separate specialized forms that most average taxpayers never encountered unless an accountant specifically flagged it. Starting in 2026, that separation narrows dramatically. The reporting system becomes unified and much harder to accidentally bypass. But here's the real shock: the thresholds. Old rules. Under previous regulations, if you were single and living in the United States, you generally only needed to file Form 8938, Statement of Specified Foreign Financial Assets, if your foreign holdings exceeded $50,000 at year-end, or $75,000 at any point during the year. For many seniors and immigrants, that felt safely out of reach. A modest savings account overseas? Probably under the limit. A small co-owned property? Maybe not counted clearly. A pension sitting quietly abroad? Often misunderstood. New 2026 Framework. For taxpayers in higher risk reporting categories, including individuals over 60 and many immigrant filers, those thresholds are effectively tightened. We're now looking at trigger points closer to $25,000 at year-end or $40,000 at any time during the year. And here's the critical part. Any time during the year means peak value, even if the account balance only crossed that line for a single day. Think about how easy it is to cross that threshold without realizing it. Example 1. You co-own property overseas with siblings. Your proportional share is valued at $28,000. You've crossed the threshold. Example 2. You have an inherited pension account you never liquidated. The balance fluctuated throughout the year and hit $42,000 in June before dropping back down. You've crossed the threshold. Example 3. Your elderly parents temporarily transferred $35,000 into a joint account in your home country for an emergency. Even though it was only there for 2 weeks, you've crossed the threshold. You weren't trying to conceal anything, but the peak value crossed the line. And that's what matters. This is exactly where people get blindsided. Most taxpayers don't track peak balances across international accounts unless they've been specifically advised to do so. They look at year-end statements and assume consistency. But Form 8938 doesn't just care about December 31st. It cares about the highest value at any moment during the calendar year. Engagement point. If this information is already clarifying things for you, take just a second to hit the like button. It genuinely helps more seniors and immigrant families see this content before it becomes a crisis. Early awareness can make all the difference between smooth compliance and months of legal stress. Section 3. The cross-checking nightmare. Here's what makes this far more serious than just extra paperwork. It's not only what you report, it's how your answers get verified. There's another critical filing requirement called the FBR, Foreign Bank Account Report. Unlike Form 8938, the FBR isn't filed with your tax return. It's submitted separately through the Treasury Department's Financial Crimes Enforcement Network, FinCEN. FBAR. Threshold. If the total combined value of all your foreign financial accounts exceeds $10,000 at any point during the year, even for one single day, you are required to file it. Notice I said combined value. That means Account 1, $4,000, Account 2, $3,000, Account 3, $3,500, total, $2,500. You've crossed the $10,000 threshold. It doesn't matter that none of them individually hit $10,000. The aggregate total is what counts. The old problem. For years, the biggest issue wasn't intentional concealment. It was fragmentation. People would answer yes on their tax return about having a foreign account, but not realize they also needed to file an FBR. File an FBAR, but fail to include required details on Form 8938. The systems weren't seamlessly integrated, and many inconsistencies slipped through without immediate detection. The 2026 reality. Cross-referencing between your Form 1040 responses, Form 8938 disclosures, and FBR filings is now far more automated and immediate. If you check yes to having foreign accounts, but no corresponding FBAR appears in the database, flagged. If you file an FBAR showing certain accounts, but fail to reflect those assets properly on your tax return, mismatch detected. If your immigration application shows property ownership abroad, but your tax return shows no foreign assets, inconsistency flagged. These systems now communicate in ways that dramatically reduce the chance that discrepancies go unnoticed. Section 4. Real-world scenario. Let me paint you a picture of how this plays out in real life. You've maintained a $12,000 savings account in your country of origin for years. You use it when you visit family. It earns minimal interest. You never thought of it as a big deal. It's just there for convenience. Under the old environment, you might never have been directly confronted about it unless a random audit occurred. Many people went years without issues. Under the new 2026 structure, you'll be asked clearly on your main tax form whether you have foreign accounts. If you answer no because you think it's insignificant, but financial data reporting shows otherwise, that contradiction becomes visible immediately. The system doesn't care about your intentions. It sees a discrepancy, and that triggers review. Section 5. The immigration connection. Here's where this moves beyond just taxes and becomes an immigration crisis. If you're a green card holder, your tax compliance history isn't just a financial matter. It's part of your immigration record. When you apply for naturalization, USCIS has the authority to examine your tax filings to evaluate good moral character and adherence to U.S. law. Historically, that review might have required manual document requests or selective investigation. Increasingly, data sharing protocols streamline that process. Let me be clear, this does not mean every discrepancy equals automatic denial, but it does mean enhanced scrutiny is far more likely if inconsistencies appear. Missed FBR filings, required forms not submitted, contradictory answers about foreign assets. These can trigger additional questioning at your naturalization interview, requests for evidence, RFE, processing delays lasting months. In severe cases, denial of citizenship applications and delays are not minor inconveniences. They can mean months of uncertainty about your future, missed oath ceremonies, travel complications, emotional stress during what should be a celebratory life transition, thousands of dollars in legal fees to resolve issues. 4. Naturalized citizens. If you're already a naturalized citizen, you might assume you're protected, but tax compliance obligations remain identical. The reporting framework doesn't distinguish based on birthplace once you're a U.S. taxpayer. If you maintain financial relationships abroad, which many naturalized Americans understandably do, you're still subject to these rules. For employment visa holders, H-1B, L-1, O-1, or other visa holders face different but equally serious risks. If you meet the substantial presence test and are considered a U.S. tax resident, these reporting rules apply to you. If you later apply for status adjustment or visa renewal, a documented pattern of non-compliance can complicate your file. Immigration officers are trained to evaluate whether applicants demonstrate respect for U.S. law. Tax violations, especially repeated or unresolved ones, raise uncomfortable questions about character and intent. Section 6. Why seniors and immigrants are targeted. This isn't random. Seniors and immigrants are disproportionately affected for specific reasons. Seniors often receive foreign pensions or Social Security type benefits, maintain long-standing accounts overseas that predate retirement, may have inherited property or accounts from deceased relatives abroad, less likely to be digitally connected to current regulatory updates, more likely to rely on outdated tax preparation advice. Immigrants frequently maintain financial ties to countries of origin, property, family accounts, inheritance interests, may have joint accounts with relatives overseas for family support, often hold on to safety net accounts in home countries. Cultural practices may involve shared family financial arrangements, may not fully understand the scope of U.S. worldwide income reporting. These are normal, human realities. But the U.S. tax system operates on worldwide income reporting. If you're a U.S. tax resident or citizen, the obligation follows you globally. Engagement point, subscription. Before we go further, if you want ongoing updates like this, especially as we move closer to 2026 and implementation details continue to evolve, make sure you're subscribed to U.S. Immigration Info and notifications are turned on. Regulatory shifts rarely arrive with loud public announcements. Staying informed early is one of the simplest ways to protect yourself. Next, we need to shift from understanding the risk to understanding exactly what you should do, starting right now, so this never becomes your crisis story. Section 7. The 5 critical action steps. If you do nothing else after watching this video, do these 5 things. Step 1. Create a complete foreign financial inventory. Document every financial connection you have outside the United States. And I mean everything, not just what feels significant. Bank accounts, even if they hold only a few $1,000s. Joint accounts with parents, siblings, or other family members. Retirement or pension accounts in your country of origin. Foreign life insurance policies that accumulate cash value. Brokerage or investment accounts. Real estate you own or co-own. Business interests abroad. Anything tied to your name or where you have signature authority. For each one, document institution name and country, account number, if applicable, most importantly, the highest value it reached at any point during the calendar year, not just December 31st. That peak balance number determines your reporting obligations. Step 2. Determine your FBAR filing requirements. Assess whether you're required to file an FBAR, not just going forward, but for prior years as well. Remember, if the combined value of all your foreign financial accounts exceeded $10,000 at any time during the year, you had a filing requirement. If you're realizing right now that you may have missed FBAR filings in previous years, don't panic. But don't ignore it either. The IRS has streamlined compliance procedures specifically designed for taxpayers whose non-compliance was non-willful, meaning you genuinely didn't know about the requirement. These programs can significantly reduce or even eliminate penalties if handled properly. But timing matters. Voluntary correction is always viewed more favorably than waiting until you're contacted by the IRS. Step 3. Evaluate Form 8938 thresholds. Determine whether you'll cross the Form 8938 thresholds under the tightened 2026 framework. If your foreign assets approach $25,000 at year end or $40,000 at any point during the year, begin gathering documentation. Now, bank statements showing peak balances, property valuation records, ownership percentage documentation for co-owned assets, pension or retirement account statements, assemble them early. Waiting until tax season creates unnecessary stress and increases the likelihood of mistakes. Step 4. Review foreign pension and government benefits. Many seniors assume that because a pension originates overseas, it's taxed only in that country. This is wrong. The United States taxes worldwide income for citizens and tax residents. In some cases, tax treaties allow credits or exclusions to prevent double taxation, but those benefits must be claimed correctly with proper documentation. This is not an area for guesswork. If you receive foreign retirement payments, social insurance benefits from another country, distributions from overseas pension accounts, speak with a professional who understands international taxation and tax treaty provisions. Step 5. Maintain organized documentation, critical for immigration applications. Especially if you're in the citizenship or green card process, maintain organized copies of everything: tax returns, all forms and schedules, FBAR confirmations, Form 8938 filings, correspondence with IRS or tax professionals, property deeds or ownership documents, bank statements. Keep both digital and physical backups. If USCIS requests documentation during an interview or through an RFE, the ability to provide it immediately demonstrates seriousness and compliance. It also dramatically reduces stress and processing delays. Section 8. Real-life case study. Let me share a real story that illustrates why this matters. Last spring, I spoke with a woman I'll call Maria. She was 68 years old, originally from India, and had lived in the United States for more than 2 decades. She raised her children here, she worked here, she paid her taxes every year without fail. When she applied for citizenship, she believed it would be straightforward. She had followed every rule she understood. During her naturalization interview, the USCIS officer asked a simple question. Do you maintain any financial accounts in foreign countries? Maria hesitated. She did have one, a savings account in India with around $15,000. She kept it for practical reasons. When she traveled back to visit family, it was convenient. It wasn't hidden. It wasn't secret. It simply existed as part of her life before immigrating. But she had never filed an FBAR. She didn't know she needed to. Under older enforcement realities, that detail might have gone unnoticed, unless triggered by something else. But with integrated data systems, the inconsistency was revealed. Her answer prompted further review. What should have been a celebratory milestone turned into 8 months of uncertainty. She had to hire a tax professional specializing in international compliance, retroactively file FBARs for multiple years, prepare written statements explaining that her non-compliance was non-willful, provide years of banking documentation, undergo additional USCIS scrutiny. The financial cost approached $3,000. The emotional cost was immeasurable. For months, she worried that a mistake born of ignorance, not dishonesty, could derail her citizenship dream. She couldn't sleep. She was stressed at family gatherings. She felt like a criminal even though she had done nothing intentionally wrong. Eventually, her case was resolved. The government accepted that she hadn't intended to conceal anything. She was approved and became a U.S. citizen. But she told me something that has stayed with me. If someone had explained this to me earlier, I would have fixed it immediately. I never wanted to do anything wrong. I just didn't know. That's why we're having this conversation now. Before 2026, before filing season 2027, before automated cross-checks become even tighter. Because the difference between a smooth process and a prolonged crisis is often just early information. Section 9. The penalty reality. Now let's talk about the part most people avoid, penalties. Not to frighten you, but so you understand exactly why proactive compliance matters. FBAR penalties. If you are required to file an FBAR and you don't, the penalties can be severe. Non-willful violations. Up to $10,000 per account, per year. Notice the wording, per account, per year. If someone had 2 foreign accounts and missed 3 years of filings, 2 accounts, X 3 years, X $10,000, $60,000 in potential penalties, willful violations. The greater of $100,000 or 50% of the account balance. Imagine having $60,000 in an overseas account and facing a $30,000 penalty simply because reporting wasn't handled correctly, and that's separate from any tax owed on income generated by that account. Form 8938 penalties. Baseline penalty for failing to file when required, $10,000. If the IRS issues a notice and the failure continues, additional penalties can accrue up to $50,000. On top of that, if foreign income associated with unreported assets is underreported, accuracy-related penalties and interest apply as well. Statute of limitations. Extension. Under normal circumstances, the IRS has 3 years to audit a tax return. But if substantial foreign income is omitted or required foreign asset disclosures are not properly filed, the window extends to 6 years. In cases involving allegations of fraud, there may effectively be no time limit at all. That means unresolved issues don't necessarily disappear with time. They can follow you indefinitely. Immigration consequences. For those in the immigration system, penalties are only one dimension. USCIS evaluates whether applicants demonstrate good moral character. Repeated tax noncompliance, unresolved tax liabilities, or findings of willful reporting failures can complicate that assessment. Again, this doesn't mean automatic denial, but it can mean deeper questioning during interviews, multiple document requests, RFEs, longer processing timelines, months or even years, potential denial in severe cases. Section 10, U.S. Social Security clarification. I want to pause here and address something that concerns many seniors specifically: U.S. Social Security benefits. Important clarification. The 2026 IRS reporting changes do not alter how your American Social Security retirement or disability benefits are taxed. That framework remains the same. Depending on your combined income, up to 85% of your U.S. Social Security benefits may be taxable, just as under current law. Nothing about this new reporting environment changes that calculation. What does draw attention? Foreign Social Security type benefits and overseas pensions. If you receive payments from another country's retirement system, whether it's Canada Pension Plan, CPP, UK State Pension, Germany's public pension system, Mexico's IMSS benefits, India's EPF, or any similar program, those payments are generally considered part of your worldwide income. As a U.S. tax resident or citizen, you must report them. Beginning in 2026, questions surrounding foreign pensions and overseas benefits are positioned more prominently in the reporting process. That means fewer opportunities for accidental omission. For retirees who have spent years dividing time between countries, this is especially important to review now, not later. Section 11. The 3 core principles. At the end of the day, this entire conversation comes down to 3 core principles. If you remember nothing else from this video, remember these. Principle 1. Knowledge creates leverage. The overwhelming majority of people who run into trouble with foreign asset reporting are not criminals. They are retirees managing modest overseas savings, parents supporting family abroad, long-term residents maintaining ties to home countries, hardworking immigrants who simply didn't realize how far U.S. tax jurisdiction extends. The fact that you're hearing about this before the 2026 tax year even begins puts you in a completely different position. You have time. You can review your accounts thoroughly, correct past oversights if necessary through IRS streamlined procedures, speak to a qualified professional before problems arise, organize documentation proactively. Most compliance crises don't explode because of complexity. They explode because of delay. Principle 2. Professional guidance is protection, not expense. International tax reporting sits at the intersection of multiple rule systems, IRS regulations, Treasury reporting requirements. For many of you, immigration law. A tax preparer who only handles basic domestic returns may not fully understand FBAR obligations, Form 8938 requirements, tax treaty nuances, how tax issues affect immigration status. Principle 3. Protect the life you've built. Whether you came to the United States decades ago or recently, whether you're approaching retirement or building your career, your stability here matters. A technical reporting requirement should never be the thing that jeopardizes your peace of mind, your citizenship application, your family's security, your immigration status. Legal disclaimer. Before we wrap up, a critical reminder. Everything discussed here is for general informational purposes only. This is not personalized legal or tax advice. Individual circumstances vary significantly. Tax treaties differ by country. Immigration status affects obligations. Policies can change. Each situation has unique factors. Always, verify details through official government sources, IRS Gov and USCIS Gov. Consult a qualified tax professional about your specific situation. Work with an immigration attorney if you have pending applications or concerns. Closing. You've worked too hard and sacrificed too much to let a reporting technicality create unnecessary stress in your life. Stay informed, stay organized, stay proactive. When you understand the rules ahead of time, they don't control you. You control the outcome. This is Ricardo from US Immigration Info. I'll see you in the next video where we continue protecting your American dream with accurate, timely information you can actually use.